For a month now, you have been sold the same story. The petrodollar is dead, China is winning, and the dollar system is cracking. But this is not just a story. It comes with a trade attached. Dump treasuries, buy gold, front-run the yuan before the empire falls. If the UAE is really fleeing the dollar, why is it asking Washington for a dollar swap line? And if the yuan is really ready to replace the dollar, why is Beijing's first instinct still to protect its own dollar reserves from anyone trying to cash out of the yuan? The yuan's structural constraint is control. If Beijing fully opens the capital account, every trading day becomes a market referendum on the Communist Party's capacity to govern. Beijing would lose control over domestic asset prices, the yuan, and elite wealth. This is not the first time people sold a dollar death story. In the 1970s, oil shocks and inflation were supposed to finish the dollar. Instead, Volcker's Fed made dollars brutally expensive, crushed inflation, and pulled capital back into the dollar system. In 2008, America's own financial system detonated. But global banks did not run from the dollar. They screamed for dollars, and Fed swap line lending peaked around $586 billion. In 2022, Russia's reserves were frozen, and the dollar system became a weapon. The old script returned: BRICS currency, gold replacement, yuan trade. Years later, BRICS still has no currency. There is a smarter bear case. The dollar survived past crises only because America paid the price. Volcker accepted a brutal recession. The Fed pumped emergency dollars into the global system. Fine, but that proves the dollar system is expensive to maintain. It does not prove the yuan can replace it. If America stops paying the cost, the world does not get a better Chinese system. It gets a more fragmented, more expensive, less liquid system. That is not a bull case for the yuan. It is a bear case for everyone. Let's stop arguing about whether oil can be sold in non-dollars. It can. The real question is what happens after the sale. Cash flow and parking are the first two tests. An oil producer needs money that settles, converts, pays imports, services debt, funds banks, and runs the state budget. Then the surplus needs a deep, liquid, exit-friendly market where it can earn yield, reduce risk, and still get out when needed. Gold fails both tests. It can store value, but it pays no interest, produces no cash flow, and cannot pay tomorrow's bills by itself. The yuan can settle one invoice, but what Beijing cannot allow is hundreds of billions of yuan freely converting, entering, exiting, and repricing. That is exactly what Beijing's capital controls prevent, and exactly what the national security logic behind them cannot allow. Then comes emergency liquidity. Anyone can talk about de-dollarization in peacetime. The stress comes in a bad week. Dollar debt due, import bills due, tanker insurance due, delayed buyers, stuck shipments, and settlement not arriving. At that moment, what do you need? Gold does not automatically become a payment tool. You still have to find a buyer or pledge it as collateral to get dollars. If you need to sell quickly, you may have to accept a discount, paying both a time cost and a money cost. The yuan has the same problem, but worse. It still has to become dollars before it can save you. So who gives you those dollars? Beijing. That would break the yuan's own anchor, China's dollar reserves. Russia? Is Moscow going to burn its own hard dollars to save your yuan trade? And behind all of this, the system needs the full financial stack: insurance, reinsurance, bank compliance, clearing, capital markets, and crisis backstops. The yuan cannot offer the full operating system behind the trade. The missing piece is trust. But trust is not just time. It is credible surrender of control. A reserve currency has to prove that in normal peacetime commerce, money can freely move under the protection of law, not political permission. Beijing cannot make that promise. Replacing the dollar means replacing the whole financial operating system behind the trade. That is not an oil contract. That is a civilization. China is the biggest demand center for Middle Eastern oil. That buyer power is real. It can negotiate prices, contracts, and more when settlement. But the card is not the button. The deal China wants is simple. You sell me oil, I pay you yuan, and you spend those yuan on my goods, equipment, engineering, and technology. China saves dollar reserves. The yuan goes out, then comes home through Chinese industry. Perfect for Beijing. But a Gulf state cannot turn all oil revenue into Chinese goods. It still has European imports, dollar debt, banks that need dollar liquidity, global investment obligations, and American weapons. So the yuan that comes in has to get out. That is the killer question. Can a Gulf central bank convert those yuan into dollars at scale, freely, predictably, and without political risk? No, because the moment Beijing allows that at scale, the whole design collapses. Yuan oil settlement is supposed to protect China's dollar reserves. If oil exporters take yuan and swap them back into China's dollars, Beijing is just spending the same dollars through a yuan middleman. That is not a sovereignty win. That is total defeat. Then the loop starts. Reserves fall, yuan confidence weakens, Gulf holdings shrink, and more holders want out. The only thing stopping that spiral is capital controls. Under those controls, the yuan can settle trades, but it cannot become a global reserve currency at scale. The China-Saudi swap line proves the ceiling. For Saudi Arabia, it expands customer channels and settlement options. For China, it supports energy security and yuan settlement. But 50 billion yuan is only about $7 billion in total under a 3-year agreement. China's crude imports from Saudi Arabia were roughly $65 billion in 2022 alone. Spend the yuan on Chinese goods, and it is export promotion. Allow it to convert into dollars, and it is still only $7 billion. For China, a bigger line risks draining its own dollar reserves. For Saudi Arabia, yuan that cannot freely become dollars is only tolerable in limited size. The rails exist, but rails are not a back office. Beijing built a payment channel, not an oil money warehouse. So what is the yuan actually doing in the Gulf? It is a bargaining chip. UAE officials have sent Washington a clear warning. Guarantee our dollar access. Do not force us to sell your assets, or we will use one alternatives. And Washington's response? Bessent didn't treat the request as a sign of retreat. He called permanent swap lines a major first step toward new dollar funding centers in the Gulf and Asia. The system isn't shrinking under this crisis headline. It's using the headline to expand. That is a negotiation strategy. You threaten Plan A because you still need Plan A and you just want better terms. That bargaining chip lets them demand better security guarantees, better weapons deals, cheaper financing, and better dollar access. Believing the story costs nothing at first. The cost begins when it becomes a trade. Sell dollar assets, dump treasuries, buy gold, buy Bitcoin, bet on the American decline trade. If that is momentum trading, fine. Call it that. But do not call it a dollar collapse thesis. Gold does not need to fall for you to lose. If it sits still or rises too slowly, the income those assets were paying you is already gone. Nobody is buying treasuries is the narrative's loudest line. It may also be the most expensive one to believe. When panic pushes yields up and prices down, that is often the entry point, not the exit. Treasuries bought at high yields can pay through interest, and again through price rebound if yields fall later. Run from them because America's over, and you may miss both. Yes, there is a serious bear case against treasuries, sticky inflation, rising deficits, and higher term premiums. But that is a price argument, not a death certificate. Iran's war did not break the dollar system. The UAE did not walk out of it. The headlines that say otherwise are not reporting. They are recruiting. Do not get recruited into selling a system that is still paying you in exchange for a system that still does not have a back office. That's the case. If the argument held up for you, 3 things help this channel keep going. Subscribe so the next breakdown finds you. Leave a comment, especially if you think I got something wrong, and share this with one person who wants to see the system underneath the headline. Thanks for watching. See you in the next one.